The US dollar has stalled around 102 mark. If we are speaking about the US dollar index, which tracks dynamics of the American currency versus the currencies of America's main trading partners, there is a kind of consolidation, a kind of correction here after the temporary top formed around 102. And this technical chart of the US currency shows us that the weakening of the greenback may still not be over. We may still see lower levels of the American currency, but let's discuss fundamental factors for us to understand why the US dollar is moving in such a fashion, and then to compare it with other currencies. So fundamentally, the US dollar is still trading ahead of the Federal Reserve's December meeting. We have spoken about this meeting for several months, and finally it will take place next week. So finally we will find out how the Federal Reserve acts. However, at this point in time, the rate hike in December by the Federal Reserve is already completely priced in by the market. Let's have a look at this chart. You can see, I hope, clearly. This is the information from CME, and it shows us that the rate hike by the Fed is almost 95% priced in, that the Federal Reserve will increase its federal funds rate to from 50 to 75 basis points range. And this is a scenario everyone is pretty ready to see. Also, we saw that US non-farm payrolls data, which were released on Friday, were rather good. The figures, the gain in non-farm employment in November was significant. 178,000 new jobs was created in the United States in the non-farm industry, and it is pretty in line with the Federal Reserve's rate hike. So no divergence from this scenario is expected. The unemployment rate in America has declined, which is also good and also confirms this rate hike scenario. Although we saw a decrease in the pace of average earnings rate, still the general inflation expectations for America are high. They are linked with expectations that the newly elected President Donald Trump is going to conduct monetary stimulus and fiscal stimulus policy. Which will increase inflation in the United States. So despite weak average earnings, inflation is still expected to accelerate in the US. And this is another reason for the Federal Reserve to finally raise interest rate. So this is why this scenario looks like a given for us for December, the scenario of the Fed's rate hike, and everyone is ready to such turn of events by now. So it is not surprising, and by this time this factor is no longer moving the US dollar, is no longer helping the US dollar to appreciate. We also see that Treasury yields have paused their advance. Here is the chart that shows it. This is the chart of US 10-year Treasury yields, the daily chart. And we can see here a kind of a top and a consolidation. The yields are in range. So all this leads us to believe that in the coming days ahead of the Federal Reserve's meeting next Wednesday, we will see the currency pairs which contain the US dollar more or less in consolidative mood, and the risks to the US currency are currently on the downside, despite the fact that the rate hike is certainly a positive factor for the US dollar as it is priced in already. We already saw the US dollar increase in November, and currently the market players are fixing their profit, taking their profit on this November increase of the US currency, and it is unlikely that they will initiate any new bullish position just on this run up to the Federal Reserve's meeting. As for other currency pairs and other currencies, let's have a look at fundamental factors and then at technical picture. We start with euro.